we've done a lot with brands. We've had Kiva, we've had Binsk, we've had Garden Society talking about their strategies and execution on how to move into new markets. But today we have a different perspective. I think it'll be very valuable to have the perspective of investors. An investor, it is driving the growth of these strategies and the supporting these strategies. And no better investor guest in the industry than Patrick Ray from Poseidon Ventures. Patrick, welcome to the show, and glad to have you on. Thanks for coming.
Thanks, Eric. It's a pleasure to be here.
So I think most people in the industry know Poseidon. You guys have been at it for, I guess, 8 years now. I think 2014 was that when the company was founded, and I know you joined them more recently, but you also been in the industry since the early teens. And so you guys have an amazing perspective on the evolution of the industry. But just give it, for those who might not know as much about Poseidon as they should, give a little bit of background if you don't mind on Poseidon and what you guys are looking to do.
Sure. Poseidon is an investment company. We manage venture capital funds and other investment funds focused on the cannabis industry. We, like Eric mentioned, we all started out investigating the industry in 2013, started raising capital in 14 and deploying capital in 14 and 15. I ran Canopy Boulder, a business accelerator focused on the cannabis industry, invested in over 100 ancillary products and services, data, software, tech, media businesses. Emily and Morgan Paxia, the founders of Poseidon, took a different path and ran a hedge fund strategy and then a venture strategy that invested in licensed operators as well. Came together in 2021 and launched our third fund for Poseidon, the Poseidon Garden Fund. It's focused on earlier stage businesses in the cannabis industry, and we've invested in, I think, 11 or 12 businesses so far.
And if I'm not mistaken, you still have some dry powder and you're still making in some investments.
Yeah, absolutely. We are looking at investments every day. A lot of interest on our side in early stage licensed operations or brand plays. So we've been spending a whole lot of time in that sector. I'm excited to talk a little bit about the things that we've learned through investments, existing investments, but also in looking at the landscape of new investments, where there are opportunities and where there are risks.
Great. Well, let's jump in then. So at the high level, right? I mean, we'll get pretty granular here as we go forward. But from your perspective, when a brand comes to you and says, we're moving into new markets, what to you is the most important driver of a market expansion? Is it increasing their revenue? Is it increasing their brand, awareness? Is it how many doors are you in? What are the, is it all about the exit strategy? For you, how do you look at that? And what do you say, okay, at the 30,000 foot level, you've got to move into new markets for what are the key drivers there? What reasons?
Well, the first thing we're going to look at is we're going to look in the rearview mirror of business and try to understand what they've done to get to where they are, how they've performed, and then see if that is a stable, clean entity, that there's no skeletons in the closet, right? And then we're going to check that first and understand that first. And then we're going to look to the strategy, the go forward strategy. Obviously, it's going to be really important that they've already executed an expansion into a new market before they raise capital to do more, right? There's the classic, you're a brand in your home state. Hopefully you own your home. You're very successful there. And then you've taken the capital, the profits from that business in your home state and proven that you can go to another state and successfully execute, because they're very different business models. They require very different skill sets. You're giving up a lot of control in some elements. Maybe you're not, like there's not just one size fits all for brand expansion. And then, so then we want to think about, okay, where are you going next? Every state is different. Every market is different. There are more mature markets. There are emerging markets. There's the states take very different approaches to legalization, limited license, unlimited license, and then the structures under which they allow businesses to operate. That's very important. So before we even get to, how many SKUs, what's the brand awareness, what are the forecasts, how many doors you going in to, like at the 30,000 foot level, we really want to make sure that conceptually the plan makes sense and projects to a positive return, because we're investors, right? And when you bring on investors, the first thing you should understand is that those investors want a return. They're not looking to deploy their capital into a business that won't ever return it. And they will have a return target. Most sophisticated investors will have a return target. So it's important to make sure then that our interests and our targets for return align with the potential for returns in the business. And if they don't, that's fine. We're not the right investor for them. Maybe we can refer them on to someone else. So that's how we start.
That's how you start. So, I mean, and then let's just jump forward to the end real quick. I mean, obviously, you folks make your returns not through dividends, but through M&A and return on invested capital. And obviously, some of these brands that you're working with are trying to become leaders in the CPG and are ultimately looking for that exit strategy. But do you feel then, based on ROI, that everyone needs to have the same view of their brand expansion and say, no, it's not revenue at all costs to grow the top line. You should be able to move into a new market and turn profitable pretty quickly? I mean, is that ROI on the expansion something that you feel they'd be able to deliver against within whatever 12 to 18 months in terms of
Yeah, so if it's a brand, an asset light brand licensing business and it is not profitable, it's a hard no. It should be profitable. I mean, there's not a whole lot of expenses. You're essentially deferring some of the heaviest lifting to the license partner and charging a take rate, right? Which on average is 6 to 12%. We're seeing across the country, blended either royalty or some combination of royalty and services, paid services, or packaging that the license holder is supplying to the licensee. So yeah, it needs to be profitable. It should be profitable. If it's not profitable, I think the brand business owners should go back and sharpen their pencils. Does that make sense? I think we lost Erik.
Yeah, I think we have too. This is Rob jumping back in as well, Patrick. I think Erik.
No worries. I can keep going.
Yeah, no, I think he's left. I think he's going to jump back in. So
okay,
I'm going to jump in for a minute as well, but we've lost the slide, kind of the primer in the meantime that Erik has. So before we jumped on the call, you had mentioned some of the people that you'd reached out to. And so again, with in mind, what we're trying to do is help our listeners apply best practices in a sense that will help them go into additional states and generate a greater footprint and consumer marketplace for their goods and services. Can you kind of continue along the path you're going on following that?
Yeah, sure. I mean, I think there's no one size fits all approach to licensing your brand into other states, other partners. I mean, partner selection is critical. It's hypercritical. And in this industry, it's not uncommon for a brand to go through multiple partners to find a partner in a state. And that's not just like vetting, but that's actually going into business, like getting married to that local partner and giving it a go to find out if they're going to stick to the SOPs. Do they want to sign up for and adhere to a quality management system, a QMS, to help you as a brand creator, owner, sleep well at night? Accountability, execution are critical when you're picking a partner in a new state that you want to expand into. And frankly, there's just not a lot of operating history. There's a whole lot of folks that have licenses and they're looking for ways to draw in more customers into the stores that they own utilizing brands. And so it's very difficult. And even the best and the biggest brands in the country struggle at identifying and selecting partners for the long term. At the same time, it's very important to think about what you will do as the owner of the brand and what the license holder in the local state will do when we're talking about investments in capital infrastructure. If, say, it's a beverage and you need a beverage line to execute, maybe $500,000 needed to invest into a system to be able to sell the products. Who's going to make that CapEx outlay, and who will own it? How will that work? But then there's also sort of sales, marketing, education, all the things that you've got to think about, like executing. Who's going to be analyzing the data to figure out the right SKU mix? It's just roles and responsibilities are very, very important. And that obviously directly correlates to the overall take rate of the brand, of the sales that come from the local licensor. Does that help?
Gotcha. I'm gonna jump out and hand it back over to Erik. But
Yeah,
thank you, Patrick.
I'm going to blame that one on the California storms. Okay. My apologies, everybody. No, thanks, Patrick. Well, I think what's interesting is we're in a market right now where we read every day about the strategy of the MSOs. And what we see every day is the MSOs are generally saying, go deeper and deeper and deeper into the markets that we're already operating in, right? Really leverage the vertical nature of their building and not taking their brands, some of which are very solid and leading market brands, in a brand expansion model to partner with others. So when you look at that and you say, well, geez, if the biggest companies in the industry are staying put in their markets and going deeper and more vertical, does that give you pause? I mean, it's the classic narrow and deep versus broad and shallow. Does that give you pause that an expansion strategy is really expensive and can get you sideways pretty quick if you get over your skis?
Well, I think what it says to me is that, there is no brand loyalty in the cannabis industry. There's brand awareness when we think about traditional CPG brands. But if there's anything close to loyalty in the cannabis industry, it's typically with the retailer. And, a multi-state operator or a well-run single state operator or a vertical, anyone can generate customer loyalty to their brand. I think, a great example in Colorado was DeepRoots, right? They were early in creating a brand around their stores, and LiveWell was another one. And that was a brand more around their store, and they would insert their own branded products into the store. To a consumer, they don't know the difference in the early stages between a house brand and some other brand that may be on the shelf. I'll tell you a story. In the early days, probably 2015, 2016 time, Colorado, I had an investor in from out of town, out of state, that had never been in a legal cannabis state. And I took him to a dispensary, and we went to this dispensary, and I knew the bud tender and the owner, and we were friends, and we were sort of chatting it up and having a nice conversation. The investor was like, hey, let me take a look at those pre-rolls. I've heard about these pre-rolls. Remember, this is like 15, 16, so it was a new thing. And the bud tender went up onto the top shelf and grabbed a branded pre-roll. And I won't say who the brand is, but it was one of the earliest movers in flower branding in Colorado. And if anybody's in the industry, hopefully they know who it is. And then they grabbed another pre-roll from in the case, which was the house brand, and put them back on the table in front of that investor and said, the investor picked him up and looked at him and was like, oh, looked at the bud tender. He said, what's the difference? The bud tender deadpanned about $5. So what does that say? At that time, there was no brand loyalty and there was no awareness. And the bud tender had enormous influence on the purchasing decision at the shelf, at the store. What's different? Today, there are many more brands. There's more noise. There are still house brands that sell at a higher margin for the store. Bud tenders remain highly influential. They are the influencers of the cannabis industry. And, there are platforms now, though. The difference is there are software platforms like Sparkplug is one of those. Alpine IQ is another. There's a couple others that are really focusing on Zoltrain to get bud tenders. Happy Cabbage is another one. Bud tenders educated and some rewarded for selling a brand in their store, paid for by the brand. So technology has caught up to the reality in the store to give these brands a fighting chance at a price, but give them a fighting chance against competing against the house brand.
So you've got that the ability to go shallow and broad and expand into new markets. In your opinion, the critical success factor there has to be sales and marketing, right? I mean, because you just gave a detailed explanation.
Mm-hmm.
I mean, yeah, you need to know what the supply chain, you need to pick a good partner. We'll get to what goes into that. But at the end of the day, that recommendation, that bud tender, you've got to have a strategy to
Yeah, what I would probably say is, sorry, Eric, you froze up on me. What I would probably say is that, going shallow is, I don't know. I mean, it's definitely a bit of a red flag when we find a brand that says we're going to expand into 11 markets next year. That's a little concerning because I think, almost it's hard. It's not easy to go and launch into new states, and you don't want to have a misstep in this market. So going shallow and broad really quick, probably not the right strategy. With that strategy, we'll expect and we've seen over and over again, the brands have to pull back and find a new partner for all those things, because you just can't diligence, vet all those partners that fast. So, an aggressive approach that I've seen from companies and founders is 3-4 states in a year. 6 is aggressive. When I hear 11, I'm like, how are you? Are you okay? How's it going? Because I think there's going to be a high failure rate if you try to go too broad, too fast, too shallow. I'd rather see very sort of smart partner selection, licensed partner selection on the ground. Are you going into a unlimited license state with a small partner or a big partner, or a limited license state with a small partner or a big partner? What do the unit economics look like? What is your take rate? And then how are you successful? What do you learn and how do you become successful? And do you create a formula that you can take to more and more states? Certainly with a large partner on the ground, you're probably going to get a smaller take rate because they have broader distribution for you in that state more quickly, right? And you're going to pay for that. They made the investments and they want to get a return on that. So that should be expected to get a take rate on the lower end. But there's going to be, you'll probably get more attention in that store potentially, or maybe you'll get less attention. You really have to understand the partners. And if you're trying to raise capital, you're going to get asked a lot of questions about who, when, where, how, why, and those answers need to be succinct, crisp, and also tie to the financial pro forma. Because look, from the investor community right now in cannabis has gotten smaller. It hasn't gotten larger in the last 12 months. I just actually heard of another well-known investment fund that is taking a step back from cannabis. So absent the family offices, the hedge funds, the angels who've maybe already deployed all their capital, you're left with folks like me, who have been investing in this space for 6, 7, 8 years, and we've seen it all many times. So we're going to ask harder questions. Look, if you have the option to go raise money from your rich aunt, or the uncle, really believes in you, you should, before you come and talk to folks like us. But if you come and talk to folks like us, we will absolutely help you cut costs that are unnecessary, make better decisions, and increase your probability of success. We've done this over and over with businesses, and it's one of the reasons why we are on our 3rd investment fund in the cannabis industry, because we've been able to return capital to investors through responsible allocation, active participation, and helping of the founders that we invest in.
Great. Thanks, Patrick. And again, apologies, and appreciate your up. So let's go on to kind of your role. I mean, what is your role in the expansion strategy? You just kind of cheerleading, or are you helping? Are you rolling up your sleeves and helping pick the states? What do you view the investor's job as?
Well, yeah, I mean, you don't want to find no investor. Well, I'm not, and we're not investors who want to play CEO, not at all. But we do want to be on the board. We want to be a resource. And every investor is different. The investor's role, experience, and potential for adding value to the business is different. They may be a product-focused investor. They may be a connector. They may be someone who helps you with keep your governance tight, right? Which is a real great investment in time and energy, especially when you think to the exit and work back.
Yep.
And then there are financially driven and investors that really help, work through the unit economics and make sure that every T is crossed, every I is dotted. And you need that whole suite of skills when you're doing this stuff, because it is not easy. If you think it's easy, you should probably be doing something else, because you've already made a bad assessment of the market, right? It's not easy. So for us, we're on the board as investors. We're helping mostly in the brand situation, introduce and vet local partners on the ground, right? Because we've invested collectively, I think at Poseidon, maybe over 160 companies. So there's very few. I have 10 to 14 calls a day with companies, my team members and our portfolio companies, so prospects as well, and portfolio companies. So if you're a brand and you're considering going into Missouri, and you're trying to understand who's the right partner, we've talked to almost every license holder in Missouri and have some sort of perspective, data, insight into how they operate and whether or not they're the right partner for you. So, we're here to help. What we want to do is, like what we've always been doing is, what would normally take you as a founder to accomplish in a month, we want to help make it happen in a week. What would take you a week to accomplish, we want to help make it happen in a day. There's a lot of value, I think, in that energy efficiency, and the one thing that is not infinitely expandable for all of us is time. So if we can help make better decisions faster, that's where there can be a big difference between an investor who's active and experienced in the industry and has a network, and one who's just writing a check.
Yeah. So that experience of choosing the right partner, choosing the wrong partner, and living through the wrong partner experiences, that's something that you spend a lot of time on. What are kind of what are the learnings from choosing the wrong partner? What have you found to say, what, next time I am not going to ignore that, or what have you? What are the things that you've taken on as maybe a different perspective than an entrepreneur might look at and be like, oh, they didn't know the proper extraction techniques, whereas you might look more at the balance sheet. What are the things that you tend to look at to support your portfolio companies moving into new markets?
I think it's really trying to get a holistic view on the partner I mean, this is a widely private industry, and there are a lot of nooks and crannies in which to hide bad practices, mistakes, whether it's from an execution standpoint, from an operation standpoint, or from a financial standpoint. You know, partnering, when you're a brand and you're looking to go into a new state, you've got an asset that you are loaning to another partner. So you need to think of yourself as an investor that's providing an asset that will help grow another business as well as yours, right? So you need to approach that partnership like an investor would, and that's our specialty, is vetting opportunities, and no one bats 1,000, right? But you know, so you got to really do due diligence on the partner, top to bottom. So that's where I think an investor can really help, is saying, look, okay, here's the checklist. This is how we vetted you, or this is how we vet other opportunities. Let's go do it. And that's what we like to do. We're researchers. We're diggers. We're trying to find the no. We're trying to find the reasons to say yes. And, with the right investor partner, you've got a team that is invested in your success and will help in that effort, because it's truly daunting, all the things, all the boxes you need to check. So, I think it's wise to invest or bring on an investment partner who has experience in the industry and can help you find the risks.
But it's really almost a due diligence exercise on your partner.
Yes,
Maybe you're not going to write a check to that partner, but it matters to your portfolio company, and you're doing a pretty deep dive. They're sharing with you their financials and their balance sheet. You're looking at everything.
Yes, and it's easy to get emotional and be excited about new opportunities. And investors feel that. Everyone feels like, anyone who's in the cannabis industry has got some sort of like excitement driving them for the opportunity, whatever it may be. But I think investors and very experienced serial entrepreneurs can have the ability to disassociate from that emotion and just look at it without any emotion, without any bias. And we are a team that keeps ourselves in check when we're working on this together with a brand founder. So yeah, absolutely. It's not a small undertaking. With the limited capital and resources in the cannabis industry, you really need to surround yourself with people who are, rowing in unison towards a similar goal and are happy to dive in, happy to do that extra call, happy to help you with your cap table, happy to dig into the financial data room that the partner shares these. So it's I don't know, it seems to make sense to me, but with investors, it's, they're looking for return too. So, like I said, if you can get money from your rich uncle, do that.
Yeah, well, I think it's interesting that you've shared that it's not you're not batting 1,000. You're not picking the perfect partner every time. And what happens in this CPG world is you can do serious brand damage if you mess up in a market. Either the quality is not there, or you could really turn off consumers. So you've got this situation where, okay, going into it that maybe the partner you pick, your eyes are wide open, you hope for the best, but if you're going into 10 markets, you're going to stumble a few times in a few markets, and you've got to manage that brand risk, right? What are the things that, when you think about managing the IP risk, managing the brand risk, are things that you can say, okay, don't get over your skis, don't go too aggressively, because at some point, if you go into a market and the quality of your product doesn't stack up, how do you recoup that with the bud tenders? How do you recoup that with the distribution channels, right? It's tricky.
Yeah. So let me answer this question in a way that maybe you're not expecting. So in my preparation for this webinar, I reached out to a number of my contacts to freshen or get fresh perspectives from people that I trust, that I know, that have been in the space from different perspectives. And one of the experts I spoke to, she said there's been a lot of brands that have raised too much capital at too high evaluations because they projected a target addressable market for their brand sales that was much too large. And they felt they needed to live up to the plan and expand into 11 states in a year and a half. And that was a mistake because there's a high failure rate when one does that, because you can't do the due diligence required to vet the partner as well as you should, and you will naturally have failures, especially in this industry. So her advice was to raise less capital at a lower valuation with a target addressable market for the business that the business will achieve in the runway provided by this capital, that allows for less rapid expansion, but more successful, a higher success rate in expansion. So I think, Eric, when, I don't know if you're on, but I was saying, 11 in 12 to 18 months, red flag. You're going to have, maybe 6 will fail because you just haven't been able to vet them. So, 3 to 4 in 12 to 18 months is aggressive from an investor's perspective. So maybe ratchet back. Don't, as a founder, don't go too big too fast. Don't project out a huge revenue stream in a short amount of time, even though you think that their investors will be wowed by that, but bring it back down to reality. And I think maybe founders have more license to do that now than they did 12 to 18 months ago when it was growth at all costs. And now investors are like, hey, we don't know if there's going to be another check at the end of this runway for you to another investor, or we're here, but if you don't do well, we're not, we may not be able to invest in the next round, and there won't be another investor. So let's make sure we cross this bridge successfully.
Yeah, interesting. So we've talked a lot about partner selection and finding good people, finding good partners, and what goes into that. The other piece that I think is so fascinating is, a lot of brands I talk to are just like, hey, this is my best-selling product in California. I really want to launch it in Arizona, Nevada, New York, what have you. Product market fit, right? In terms of the risk of your brand expansion strategy. Talk a little bit about what that means to you as an investor, and how much you expect your portfolio companies to understand about the competitive environment, down to the detail of how are your competitors pricing in these markets that are always so different in their construct.
Yeah, well, I mean, for us, it's a red flag whenever we see a business, wherever it's sort of born. Okay, so the example here is California, that says, their reasoning for going into, New York and Nevada and Colorado, Michigan, is because they feel those are good markets, and they have a buddy there who they've already sort of got a handshake agreement to go into, and it's done. That's a red flag. What's a green light is when they present, look, here's the state. This is what we understand about it. We've got headset data, we've got BDS data, where, we understand, they're looking at the data and allowing the data to drive decisions on SKU, product offering and mix, price points. They've done the work and understand promotional strategy. They have, identified how the bud tenders are important and how they'll address them, incentivize them, and then what the plan for continued marketing is in that state. So I don't know if that answers your question, but we're talking about how they expand, how they make choices. We want to see it driven by data.
Yeah, I think what a lot of brands struggle with, that when they go deeper into their core market, they typically do so by introducing new products, right? Like, oh, I got a foothold in vape, I got a foothold in edibles, I'm going to launch new edibles, I'm going to launch new products. And then they start to get this, conceptually that, well, if I go into new product markets, I don't really know what's going to fly. I'm going to throw some against the wall and hope some of it sticks. So I'm going to go in with my house of brands. So I always got something to sell. There's all, my sales guy can walk in the door. What's on the shelf? Oh, we don't have any gummies right now. Well, I make a gummy, right? And so there's that, like, they almost think that having a broad set of SKUs is a strategic competitive advantage. But I think, there's a lot of other brands that are like, no, I'm going in with a single focused launch. Okay, maybe I got a couple of SKUs within my category, but I'm going in to be, laser focused on one thing and compete there and win there. And then when I win, or at least am relevant, I can launch new products. When you look at that, that product market fit and those strategies, are there, things that make your hair stand up on your neck when you're saying, no, that's way too risky? Or, how do you look at that and work through that process with your portfolio companies?
Well, I mean, I'd much rather, there's certainly going to be a need for some sort of responsive approach to the market, right? And there's data tools like Pistol Data, Hoodie Analytics that allow brands to rapidly assess inventory in dispensaries and enable their salespeople to be more efficient in targeting retail opportunities. This is another evolution of the industry from when we all started. Having options, yes, great. But, if you're just another gummy on the shelf, you're great, but, what's your staying power? For us as investors, even if you have a hero product that's #1 in the category and dominant in a number of markets, that's great. And that is a business today that should allow you to realize a vision of tomorrow, which is to still be in business tomorrow down the road. But what will get you there is not rocket science. And it's something that's been, part of CPG and branding and product development for years, which is a R&D and product development strategy focused on developing the next better thing in the categories that you're in. So Wana is a great example of a company that has tried to differentiate itself by coming up with sleep gummies that have minor rare cannabinoids in them. They started out with like 3-4 flavors of gummies, right? And they were all the same besides, sativa, indica, hybrid, right? So we start with those 3 products. Then we start adding rare cannabinoids, and then we start adding fast acting, and then we start blending in other ingredients, right? And this is all part of a product development strategy that keeps them relevant, that provides new things for not only consumers, but bud tenders to get excited about, and allows them to stay one step ahead of the competition in that journey to tomorrow. So as an investor, if you're like, hey, I got a great product, like I'm ready to go into 15 states and I want your funding, it's like, okay, I love your product, it's awesome today, what about in 6 months when everybody sees in the data that product kills it and they come out with competitors? Just like technology, just like any other business, you have to keep evolving. And if we don't see an R&D line in there, in that P&L, and a product development team or expert in the business that is going to drive innovation and bring up, hey, this is great, I'm happy with where we are, but my job is to think down the road and make sure that all you on our team that are executing so well and the brand that we have lives on, that is in critical importance.
That's great. That's great advice, Patrick. I think that, one thing I hear often about somebody with something innovative is that they're terrified about teaching their partner, which could be a co-manufacturer, it could be a brand in a market, or it could be an MSO, teaching them how to differentiate, that they spent all this time figuring something out. And now they're like, well, how am I going to protect my IP? I've got to tell them how to make it. I've got to tell them how to market it. I got to give them my secret sauce. When you look at this in CPG and the value of IP at the end, in the end game here, what advice do you give your portfolio companies about, just the entire issue around the IP? Do you feel that they're, kind of get over it, or do you just need the proper, contracts in place? What are IP-based strategies that might concern you, or even, that you would advocate for as these companies kind of, expose themselves to the world of cannabis, which, as we know, word gets around.
Yeah, this is one of the challenges of investing in brands today and being an entrepreneur launching a brand, is that the infrastructure that exists and is proven out to protect those trade secrets or intellectual property in conventional CPG, mainstream CPG, and I'm talking about centralized contract manufacturing at scale, talking about distribution, national distribution, branding and marketing agencies, sales agencies, brokerage, that just doesn't exist in cannabis at scale. And the reason that those businesses in conventional CPG grow to scale is because they preserve that IP for their clients and they don't compete with their clients. So getting to valuation, which I think is important in mainstream VC or conventional CPG, let's even do a better for you product category, an alternative product category, so natural and organic foods, industry that I worked in for 15 years. Your average valuation multiples for, let's say, a beverage, a new age beverage brand, exit multiples when a company sells, and this is rough because it's top line, not as refined as EBITDA. The multiples 3.4x last 12 months revenues. So ask yourself, in that industry where you can build or source to one contract manufacturer with consistency, reliability, precision, and build at scale with better pricing, distribute nationally through one or two distributors of natural products, reach every store you want to, where there are agencies that specialize in reaching consumers without limitations on what can necessarily be said, like we do have in the cannabis industry, and brokers who will represent your brand and getting it into the store so you can focus on marketing at the national scale. Or without all of that, should there be a premium put on cannabis brands or a discount? This goes back to the how much do you raise at what valuation to increase your probability of success. And most entrepreneurs logically think, I got to raise as much as I possibly can so I have more gas in the tank to be able to climb that mountain that I know I have ahead of me to be successful with my brand. Well, if you raise a lot of money at a low, in an environment where investors are putting a discount to conventional multiples, you're going to give up a lot of equity, and you're going to have to ask yourself, is this even worth it? So, again, going back to the expansion strategy, this is a iterative process that you don't, you're putting one foot in front of the other. Maybe you've got two parallel paths, maybe three into new states. But once you get into like 6, 7, 8, 9, 10, 11, your probability of failure goes up, your probability of success goes down. You need to raise more capital to do that. Why not move more diligently, maybe a little more conservatively, but make sure that you build a platform of success that then you can raise more capital onto at a higher valuation because you've proven that you can execute to expand into other states. So
that's great.
I'll get off my soapbox there.
Custodians of the capital. So Great. We actually have a couple really good questions here I want to fire at you. So we'll go rapid shot here. I mean, one asks, what is a reasonable sales and marketing budget to enter into a new market? I mean, how much money should you think would be a reasonable, like, okay, I got $1 million, $500,000, 100,000. I know it's obviously different, but what should the expectation be in terms of entering a new market and succeeding and competing in those markets?
Yeah, so if it's asset heavy and you need to invest in CapEx for a bottling line or a packaging line or something, you might need to allocate $500,000 plus minus into a new state. If it's asset light, it might be between 150 and 200K. So it really depends. It's hard to put those hard and fast rules out there, especially it varies on what state you're entering, whether it's a limited or an unlimited license state, and what the competitive landscape is. Is it an emerging market or is it more mature market? These are all dynamics that factor into the equation to answer that question. But fortunately, today, there's great data in headset and BDSA data to help answer those questions, so that it's not just pulling a number out of the sky.
I think where that also has impact is, your partner is saying, well, what's your sales and marketing budget? Like, how much are you going to support? And a lot of brands are taking the position in this negotiation of, well, all right, I've got $250,000 that I'm going to invest. I'm going to actually hire my own salesperson. I'll invest in marketing. Obviously, I got to buy product from you and inventory. But therefore, I need a royalty rate that is significantly higher to give the ROI that my investors are looking for in this market. So sometimes investors or brands want to leverage the amount of money they're spending to negotiate a higher royalty, because I think prudently they're saying, I need the ROI, plus look what I'm doing to support the brand. I'm doing way more than others. Yep. You kind of look at that and say, is that market entry capital directly associated with what you should be getting ROI on and what you should be taking back out of the market? Or, so is it, hey, I actually don't want to do anything. I'm not going to give you any money. You take it and run with it. Do the best you can, and I'll do those mailbox checks that are going to be huge, I'm sure, but I haven't spent that much money, so everything's ROI. How do you look at that negotiation and the investment into a new market and kind of help brands step through that strategy?
I would say that there's probably not enough data to prove one strategy or the other. And again, going back to all the variables of what state you're going into, who the partner is, what is their footprint of retail assets, it's, how much money you need to invest into going into a state with a partner who has a retail reach of 10 stores versus 100 stores, meaningfully different, right? So the capital raised has to align logically with the opportunity. So again, hard and fast, give me a number is not the right, I would say that's a difficult question to answer. And we've seen over and over again, companies raise a ton of capital and throw a lot of money at advertising and have the same results as a company that raised very little money or grew organically and didn't throw a whole lot of capital in terms of advertising and marketing and support. I don't mind seeing brands raise a lot of capital to drive adoption of products and awareness of new products in the market, because they're building the market. It's a shame to see other investors see that capital destroyed when it may and often doesn't get the return that was projected, but it enables other groups to, not be the pioneers per se, who are also kind of the arrow catchers, allows them to be the settlers, right, who circled up the wagons and built homesteads and real lives in these states. Does that make sense?
It sure does. I mean, I think that, you know, we're living kind of that right now in some respects with like the whole evolution of New York and the evolution of a state like Missouri, where we've seen kind of like completely different structures and you know, we don't need to get deep into the weeds, but in terms of like selecting new markets and confidence, are you sitting right now looking at saying, again, it will vary based on what portfolio company you're representing or talking to, but are you saying, hey, you know, you really got to stay out in X state. I think you really should move over here. Is like how much right now is this driven like on a day in, day out a cycle of news to say, okay, change in the regulation in New York, let's go now. Or Missouri started fantastic. Put your eggs into Missouri because that's a great market for brands and it's all cleared out. Like, how do you kind of manage that? You know, what's enticing to you? I guess one person asked, what's enticing, you know, for you as an investor right now in terms of market?
When it comes to a brand entering a new market, like I like to see, I think we all like to see reasonable, thoughtful approaches with as many variables eliminated as possible. What does that mean? Partners already identified, right? In states where that partner has a right to win or has a leading position and the regulatory framework is favorable to them. So like looking at Missouri, just turned on adult use, trending to meet or exceed Illinois sales. Like the market, if you're, you know, Missouri's hot right now, right? And we don't, you know, you never know until it happens. Let's compare it to New York, where they're approaching legalization in a very different way. It's very aspirational, intentional, but it's come at, there have been sacrifices to achieve those social equity goals. There's been there's this large social equity real estate fund, a $200 million partially state-owned and directed fund that, you know, in a new state, that's a lot of capital, and it was designed to play a big role in the retail rollout, and it's unclear what's going on there. That big of a contributor to the market for investors, like until it's more clear what will happen there and how that will impact the launch of this market. You know, I think a lot of investors are in a wait and see approach, as well as, you know, doing things that as the Office of Cannabis Management has made decisions that have, you know, they've made decisions which has very much slowed the rollout and damaged investors.
Is New York a hard no for you right now?
Yes. I mean, we want it to be a yes, but until there's more clarity about how this market, which has been widely viewed as a failed rollout, becomes a successful rollout where, participants who have been in the market, in the medical market, have done good work legally, followed the rules, worked with the state to have a seat at the table, then the chair is removed. Or the farmers, the hemp farmers who were able to convert to cannabis and planted crops, and then there's no retail, not enough retail for which them to sell because the state has not approved the licenses in a timely manner. I mean, that if it was your money, would you be investing in New York? Until it's more clear that you can have a predictable future that rewards all the participants, I think it's a wait and see.
Yeah, great. So we've had a bunch of great questions. We won't be able to get to them all, but let's end on this kind of, I think, a really interesting question back to the 30,000 foot level. So the question is, California legalized in 1996, yet we have we have not yet seen a killer brand in cannabis. Maybe cookies comes close. Why haven't we seen a Coca-Cola, a Nike, or an Apple in cannabis?
Well, I would argue that there's a couple reasons for that. Interstate commerce and the limitations of that make it very difficult to employ capital efficiently as an investor or as an entrepreneur to direct it in a way that allows you to reap the benefits of scale. Absent of that interstate commerce, you're having to go and put an enormous amount of energy to move into new markets. Team energy, capital, legal resources. I mean, you're essentially recreating your business in every new state. Whether or not you're doing it with a licensed partner or not, you're still having to expend a lot of energy to just get there. So that has limited the development of a national brand. In addition, all the advertising and marketing restrictions that existed. We've seen over the years many very talented and successful creatives, brand marketing, advertising execs come into the space. And I always say, they walk into they're hired, they walk into the cannabis room and they look down at their tool belt and they're missing their drill and their hammer. And then they have this realization, oh my gosh, these tools that allowed me to build success outside the cannabis industry are not available to me. And I'm talking about Google, I'm talking about Facebook, I'm talking about all those things. And it's really difficult. Today, it's getting better. There's more and more advertising networks that are being built up. There's companies that are pioneering the reach to consumers in a compliant and legal way. Companies that are helping you, like Amnesia, a company called Highlight, they're doing incredible things in terms of keeping messaging compliant, marketing content compliant, so that you don't lose your Instagram page. You can advertise in other places without the risk of losing your license or being fined. There are advertising networks, Media Gel, Rev Offers, I think it's called Catalyst. I mean, there are more options now than ever for savvy founders and operators to execute brand strategies than ever, but it is still hard.
Yeah, no, I think that's no doubt. It's fascinating. I think we're at a point where the tools are coming on, but the CPG top down, I want to create a brand. Yes, you can create a brand from scratch if you follow the CPG playbook, but there's a lot of pages ripped out in the cannabis CPG playbook. And one thing that, people always debate on is whether or not you can you create authenticity, right? Mm-hmm. And that's a topic for another day. I think we'll be talking about that in a month when we have Bethany Gomez from Brightfield on. But I think it's really fascinating to see, we're still at the first inning of brand development. There's still a ton of runway. Do you feel, just parting shot, can we create a brand? Could we sit in a room right now and create a brand and be successful in this industry out of the gate?
Well, I think so. Yes, absolutely. Not right out of the gate. Like, let's be realistic here. This is a brand is a journey, and it needs to have. It's like writing a book. You need to have your entry chapters, your prologue, build and prove that authenticity, execute in the middle, and have that conclusion, right? And authenticity is critical. And I think that you mentioned cookies, and I think there's a lot of authenticity in that brand. And, we've struggled there's no shortage of folks who have experience in developing brands and can put together a smart deck. But the execution of that is what's missing. If there's one brand out there that I would encourage people to consider as an authentic brand, that isn't sort of the Cali style brand, which has broadly dominated the cannabis industry up to this point, and I don't think will dominate long term. I think there will be brands from other regions of the country that will start eroding into that Cali culture, brand ethos. The brand that I would encourage people to take a look at that I think is really interesting is Sunburn out of Florida.
Yep.
So take a look.
Brady and crew.
Yeah.
Great. Well, that's fantastic. Patrick, thank you so much. You've enlightened me, and I'm sure you've enlightened our listeners. Appreciate you coming on board. Great advice, and yeah, we'll look forward to seeing you. I'm sure we'll see you at Unpacked and all these state-by-state events coming up. So thank you so much. Appreciate you. Thanks everybody for listening. We'll sign off today, and remember, again, in about a month's time, you'll see Bethany Gomez from Brightfield to talk about brand authenticity. So cheers, everybody. Thanks for coming, and to be continued.